Very good, dear friends. So we will begin our revision fast track or refresher series with chapter number 1, which is on basic concepts. So Income Tax Act 1961 is the base legislation governing the law relating to income tax. It extends to the whole of India, and India has been defined under section 1, as per which it includes not only the territory of India but also its territorial waters and also the airspace above its territory and territorial waters. So it includes all the three elements: land, water, and air, right? So the Income Tax Act extends to the whole of India. Section 4 is the charging section, and it deals with the question as to how is income tax charged. As per section 4, income tax shall be charged for an assessment year in accordance with and subject to the provisions of this act in respect of the total income of the previous year of every person at the rate prescribed for the year by the Annual Finance Act. If we dissect this provision of section 4, what we find is the charge is of income tax, and income tax is charged when during the assessment year. How? As per provisions of the act. On what? On the total income of a person. On the total income of which period? Of the previous year of a person at the rates prescribed by the relevant Finance Act. So income tax is charged in an assessment year on the total income of a person of the previous year. What is assessment year in previous year? It is defined under section 2(9) and section 3 respectively. Assessment year is the period of 12 months commencing on 1st April every year, and previous year is the financial year immediately preceding the assessment year. The concept of calendar year or accounting year is not relevant to the concept of assessment year in previous year. So for example, the assessment year 2023-24 means 1st April 2023 to 31st March 2024, and the corresponding previous year is financial year 2022-23, that is the period from 1st April 2022 to 31st March 2023, and therefore the total income of previous year 22-23, that is the income earned during the period 1st April 2022 to 31st March 2023, is charged to tax in the assessment year 2023-24. The concept of previous year is slightly modified in cases where the source of income itself may not exist for the whole of the previous year, right? And there can be two situations. Situation 1, where a business or profession is newly set up. In that case, the previous year begins not from 1st April but from the date of setting up of such business or profession, right? In situation 2, there may be a case where the source of income newly comes into existence during the year. In such case also, the previous year begins not from 1st April but from the date on which the source of income newly comes into existence. In both the cases, the previous year ends with 31st March of the financial year. In certain cases, the income of a previous year is taxed in that previous year itself without waiting for the assessment year, right? So if this is the previous year, normally the income would get charged to tax in the following assessment year. However, in certain cases, the assessment of income is accelerated. That means instead of waiting for the assessment year, the income is charged in the year in which it is earned, that is in the previous year itself. And these provisions are contained in section 172, 174, 174A, 175 and 176. We will look at two provisions only. The other provisions we are not going to look in this refresher video because they may not be very important for the purposes of exams. One is section 174, which deals with persons leaving India. Section 174 covers a situation where it appears to the AO, the assessing officer, that any individual may leave India during the current year or shortly after its expiry, and he has no present intention of returning to India. If such is the case, then the total income of such individual for the period 1st April of that year up to the probable date of departure from India shall be chargeable to tax in that assessment year. That means in that year, without waiting for the next year. Section 176 deals with a case of discontinued business, right? Okay, these circles, these symbols denote that a question on this particular topic has been asked in a previous examination. And these symbols are given throughout the book. Where any business or profession is discontinued in an assessment year. In that case, the income of the period from 1st April of that year up to the date of such discontinuance may be charged to tax in that assessment year in the discretion of the assessing officer, right? So if the year is 2022-23, okay, this is the normal previous year. So, and there is a business or profession, normally the income from such business would be charged to tax in the assessment year 2023-24, that means in the following year. However, if the business in this year is discontinued, then it is in the discretion of the assessing officer to charge the income from such business from 1st April 2022 to the date of such discontinuance. For example, if the discontinuance is on 1st October 2022, then the income from 1st April 2022 to 31st of October 2022 may be charged by the assessing officer in the year 2022-23 itself without waiting for the year 2023-24. This is called accelerated assessment. On top of this, 2022-23 would obviously be the assessment year for the previous year 21-22 as well. So two assessments will take place in the year 2022-23. One is the normal assessment for the previous year 21-22, for which the normal assessment year is 22-23. Secondly, an accelerated assessment for the income from the period 1st April to 31st October of this year will take place in this year itself without waiting for the next year, and this will be done under section 176. There are certain provisions which deal with the undisclosed sources of income. In the following cases, special provisions are made to bring undisclosed sources of income within the tax net, and these provisions are contained in sections 68, which deals with cash credit, section 69 dealing with unexplained investments, 69A dealing with unexplained money, etc., 69B dealing with amount of investments, etc., not fully disclosed in the books, section 69C dealing with unexplained expenditure, section 69D dealing with amount borrowed or repaid on hundi. We will look at the provisions of section 69B in this video. The situation that section 69B covers is a situation where in any financial year the assessee has made investments or is found to be the owner of what? Of any bullion, jewelry or other valuable article. Okay, the assessee has made investments or is found to be the owner of any bullion, jewelry or other valuable article, and the assessing officer finds that the amount spent thereon, the amount that the assessee has spent, exceeds the amount recorded in the books of account, right? If the amount spent is more than the amount which the assessee has recorded in the books of account, and the assessee offers no or unsatisfactory explanation about such excess amount. That means assessee is not able to explain the source, right? The assessee offers no or unsatisfactory explanation about such excess amount, then the excess amount may be deemed to be the income of the assessee for such financial year, and it is consequently brought to charge to tax under section 69B. Income tax is charged in respect of the total income of every person, and this term has been defined in section 231. As per section 231, person includes, so it is an inclusive definition, person includes the following. Person includes the following. Number one, individual. Individual covers only natural persons. A sole proprietorship is assessed as the individual himself. Number two, Hindu undivided family or HUF. An HUF is assessed separately from its members. Members are assessed on their own income, and HUF is assessed separately from its members on its own income. Jain and Sikh undivided families are also treated as HUF for the purposes of the Act. 3. Company. Company has been defined separately and it is taxed separately from its shareholders. Shareholders are taxed on their own income while a company is taxed on its own income. 4. A firm. Firm includes a LLP, that is a limited liability partnership, and a firm like an HUF or a company is treated separately from its partners. 5th, AOP or BOI. AOP means Association of Persons. BOI refers to body of individuals. AOP or BOI is treated separately from its members, and tax provisions are same for AOP and BOI. 6th is a local authority. 7th, an artificial juridical person which is not covered under the above categories 1 to 6. This is the residual category. So, income tax is charged in respect of the total income, and total income is computed for every person, which is defined as we discussed under section 231. The concept of assessee has been defined under section 27 and it is relevant for the purposes of the Act. The assessee means a person by whom any tax or any other sum of money is payable under the Act, right? For example, if I earn income of say 10 lakh on which tax is payable, then a sum of money, tax or sum of money is payable under the Act, and therefore I am an assessee. The term assessee includes the following. Number one, every person in respect of whom any proceeding under the Act has been taken for the assessment of his income, loss or refund, or of any other person in respect of which he is assessable, right? So if a company has a total loss for a previous year and the assessment of loss of such person has been undertaken, then such company is referred to as the assessee under the Act. Number two, every person who is deemed to be an assessee. Under the provisions of the Act, certain persons may be deemed to be an assessee. For example, in the case of a trust, the trustee is deemed to be an assessee. The trustee is the representative assessee. So the trustee will be called as the assessee under section 27. Number three, every person who is deemed to be an assessee in default is also called as an assessee. So for example, if I am supposed to deduct tax at source under a provision, but I default in deducting such tax at source, then I will be deemed to be an assessee in default. The concept of income is important. Income is defined under section 224. Income tax is charged in respect of the total income. Income tax is charged in respect of the total income, and therefore what is not income cannot be taxed. Now, we'll first talk about the general concept of income, and then we will talk about the definition of income under the Income Tax Act under section 224. Under the general concept of income, what is generally understood as income is a periodical monetary return coming in with some sort of regularity from definite or identifiable sources. So if an item falls within the general concept of income, it will be treated as income and it will be taxed under the Act unless it is specifically exempt. Certain factors are irrelevant for determining whether an item is in the nature of income, while certain factors are relevant. Some examples of factors that are irrelevant is whether the income is in cash or kind, it doesn't matter. Whether it is actually received or whether it is merely accrued, it's not relevant. Whether it's legal or illegal, what is its frequency, whether it is temporary or whether it is permanent, whether it is in lump sum or in installment, whether it is exempt or taxable, also it's not important. It will of course be called as an income. It's another matter whether it will be brought to charge to tax or not, whether it will be exempt income or whether it will be taxable income, but in the first place it will remain income. Certain factors which are relevant are if the amount is in the nature of a mere relief or reimbursement. So mere reimbursement will not be treated as income. There are two concepts of diversion of income by overriding title and application of income. Diversion of income by overriding title is that the income doesn't accrue or the person doesn't have the right to that income in the first place and therefore it cannot be charged in the hands of that person. The former, that means diversion of income, is not income. However, the latter, which is application of income, that means after you have earned an income, then you apply the income in respect of certain expenditure or any other aspect, then that is called applying the income or application of income. So in that case, the income doesn't cease to be an income merely because you are applying the income. So application of income is income, whereby an amount which is diverted by overriding title, it's not the income. Mutual activity is a concept which says that one cannot earn from self, right? So you cannot earn an income from yourself. Double taxation needs to be avoided and therefore income already taxed cannot be taxed again. Borrowing is not income. So if you take a loan from a bank, it will not be treated as income in your case. There is a concept of capital versus revenue receipt as well. And this is the relevant factor in deciding whether an income will be charged to tax or not. It is important to distinguish a receipt as revenue or capital in nature. This is because revenue receipt is taxable unless specifically exempt, right? Revenue receipt is taxable unless specifically exempt, and capital receipt is exempt unless specifically taxable because it is capital in nature. There are certain factors which are important to distinguish between the two. These are indicative factors, right? And on the basis of these factors, one can determine whether a receipt is revenue in nature or capital in nature. If it is revenue in nature, then it will be brought to tax unless it is specifically exempt under the Act. If it is capital in nature, then it will not be brought to tax unless it is specifically taxable. Now income has been specifically defined as under section 224, and section 224 contains an inclusive definition of income. That means it is not exhaustive. Thus items which are ordinarily understood as income, they are to be treated as income even if they are not specifically mentioned in the definition under section 224. Okay. Similarly, items which are not generally understood as income but they are specifically included in the definition of income are to be treated as income under the Act. Examples of such items are capital gains, gifts, compensation on termination of agency, winning from lottery, races, games, etc. And income includes a loss. So that's why a person may be assessed in respect of his income and also in respect of his or her loss. Computation of total income. Income tax is charged in respect of the total income. And total income means, it is defined under section 245. Total income means the total amount of income referred under section 5 computed in the manner laid down in this Act. We will take a look at a snapshot regarding computation of total income. These are the steps. The first step is to determine the incomes that will enter the computation. So first we determine what is the previous year. So we determine the relevant previous year, and this is as per section 3. Then we determine the residential status of the person. Okay, and this is something that we do under section 6, and the result could be either a resident or a non-resident. Then we determine the items of income which will enter the computation in respect of that person. So determine all items of income for the previous year, and this we do in accordance with the definition of income contained in section 224. Right? After that, we identify the scope of the income for that person. So we identify the incomes to be included within the scope of total income, right? And in doing so, we exclude the incomes which are outside the scope, and this is something that we do in terms of section 5. So first we determine what is the relevant previous year, because income of that previous year will be charged to tax. Then we determine what is the residential status of the person for that previous year. Then for that previous year, we identify all the items of incomes as per section 224. And then we move on to section 5, and basis the scope of total income, we determine what are the items that will be left out for the purpose of computation purpose, and what are the items that will enter the computation of total income. Once we have identified all the items of income which will enter the computation of total income, then we move to the step of classification and computation. We classify and compute income under the 5 heads of income, and this is as per section 14. The 5 heads of income are salaries, income from house property, profits and gains of business or profession, capital gains, income from other sources. And we compute the income under these heads after giving effect to the exemptions. The incomes which are exempted, they don't enter the computation of total income. We reduce the deductions available under the various provisions. We add the incomes which belong to other persons, but they are to be clubbed in the total income of the person. Then we make adjustments in respect of losses. We set off and carry forward the losses as per the provisions. And what we arrive at is the gross total income. We arrive at the GTI, or the gross total income, from which we provide deductions from GTI as per chapter 6A, and then we arrive at the total income, which is the total income computed as per section 245, and we compute tax on such total income. The total income is supposed to be rounded off under section 288A. It is to be rounded off to the nearest multiple of 10. How do we do that? First, we ignore any paise. Then we see if the last figure is 5 or more, we increase it to the next higher multiple of 10, and if the last figure is less than 5, we reduce it to the next lower multiple of 10. So if the total income is rupees 1,45,345.80 paise, it will be rounded off to rupees 1,45,350. Should income be computed on due basis or receipt basis? There are 5 heads of income, as we know. In the case of salaries, income from house property and capital gain, method of accounting is not relevant. Whether the assessee is following cash method or mercantile method, it is not relevant, and income is computed on the basis of specific provisions of the Act dealing with these heads of income. If we talk about the heads of PGBP and IFOS, then income is computed in accordance with cash or mercantile system of accounting, which is regularly employed by the assessee. Once the total income is determined, then we move to the computation of tax liability, after which we determine whether tax is finally payable or refundable. So how do we do that? First of all, we compute tax on the total income. Then we add interest and penalty if leviable under the Act. We make deductions on account of prepaid taxes, taxes which have been prepaid by the person, and they can be either in the form of tax paid on self-assessment or advance tax, or in the form of TDS or TCS, and the result is the amount of tax liability which is either tax payable or refundable, and it is rounded off in the same fashion as the total income is rounded off.